Derek Kravitz, Associated Press. Last night, the president unveiled a plan to revamp and expand the government's refinancing program. Essentially, the Fed released a white paper earlier this month that said that up to 2.5 million homeowners could benefit from this and essentially save $3,000 per year in mortgage payments. Right now, there's a mortgage settlement being brokered between state attorneys general and the nation's major mortgage lenders, something to the tune of $25 billion, much of which would be in the form of principal reduction. In the white paper that was released earlier this month, the Fed seemed to indicate that principal reduction could be helpful, but it was unclear about whether they thought that this was a acceptable or even feasible option. They also made clear that a lot of the proposals that are currently out there eat around the edges, so to speak, when you're dealing with a foreclosure crisis, and a lot of economists agree. Do you think a principal reduction in the form of the major mortgage settlement would do a lot to help the housing crisis? And if not, is there any other alternative proposal that would help?
Well, the Federal Reserve obviously has a very strong interest in the housing sector. The weakness of the housing sector is an important reason why the economy is not recovering more robustly. And the problems in housing finance are part of the reason why monetary policy has not been more powerful, because part of our transmission mechanism is through lower interest rates, which affects refinancing and affects sales and purchases as well. In addition to that, as bank supervisors, we have considerable interest in servicing, in loan modifications, and in delinquencies, and all the aspects of mortgage lending. So we have a considerable interest in this area, and as you say, we did a white paper which looked at a number of issues, including refinancing and mortgage finance. I think it's important to say that our intent in that white paper was to provide the benefit of our analysis to the public and to those who would be making policy. We did not take specific stands on individual issues. What we tried to do was provide the pros and the cons and provide some context for these debates. So we did discuss refinancing. We did discuss principal forgiveness. I would say that there's a variety of views about principal forgiveness within the Federal Reserve System, and there is no official position. It seems very likely that principal forgiveness could be helpful, depending on how it's structured, in reducing delinquencies. There are also some potential drawbacks. One of them is the fact that the amount of negative equity in the United States is about $700 billion, which is enormous. And so there's no conceivable program that is going to put everybody in the country above water. And so I think the issue then becomes, if we have 20 or 25 billion or whatever the number may end up being in this settlement, what is the most cost-effective way to help as many people as possible? And I think that's an ongoing debate. But with respect to principal reduction, I've spoken about this in the past, and it certainly has some advantages. A lot depends on how it's structured, and a lot depends on what the alternatives are that you're considering.
We'll go to Peter Barnes, then Darren Gertz, and then Patrick.
Thank you, Mr. Chairman. Peter Barnes of Fox Business. One of the goals of the Fed and the release of all these new materials, the forecast, and the policy announcement are to help to create expectations and set expectations. But are you concerned at all that the materials and the forecast and the policy announcement path today might help create negative expectations? In other words, the average American's takeaway of your announcement to keep interest rates low for an exceptionally low through 2014 now might signal to them that maybe the Fed thinks that the economy is in much worse shape than we all thought. And that, in turn, could affect consumer confidence, consumer spending, and the ability to create a self-sustaining economic recovery at some point. Is there a risk of this?
Well, whenever the Fed takes a policy action, there's always some potential for a signal. I mean, that's true not just in these current times, but any time the Fed lowers or increases interest rates, and that's something we have to think about. But I think, generally speaking, that those considerations are outweighed by the need to maintain accommodative financial conditions so that it's attractive to firms to invest and hire, attractive for those who are eligible to buy homes, and so on. And I think that that ultimately is more powerful than the signal from the change in policy. In particular, the markets and the news media are very good at picking up the underlying economic data and making assessments of the state of the economy and reporting what different people think about the economy. So I wouldn't overstate the Fed's ability to massively change expectations through its statements, for example. So again, I think that while we certainly take that into account, we think it's important for us to say what we think, and we think it's important for us to provide the right amount of stimulus to try to help our economy recover from its currently underutilized condition.
Darren, and then we'll come back to Patrick.
Darren Gersh, Nightly Business Report. Let me kind of follow up on Peter's question. Why shouldn't somebody looking at these numbers from the outside say, look, as aggressive as you say you've been and as aggressive as you have been, it doesn't look like you're meeting any of your goals for the next 3 years on the economy. So why isn't the Fed doing more now?
Well, again, as I said earlier, the Fed has been doing a great deal. Just since August, we have put the date on our expected period of low interest rates. We undertook the maturity extension program, which is still continuing. Today, we announced a further extension of the expected period of low rates by issuing these expected policy rate information. We hope to convey to the market the extent to which there is support on the committee for maintaining rates at a low level for a significant time. You know, I don't accept the premise that we've been passive. We've been actually quite active in our policy, and in one respect, the low level of inflation is a validation in the following sense, that there were some who were very concerned that our balance sheet policies and the like would lead to high inflation. There's certainly no sign of that yet, and it hasn't shown up either in financial markets or in outside forecasters' expectations. Now, that being said, as I mentioned earlier, if the situation continues with inflation below target and unemployment declining at a rate which is very, very slow, then our framework, the logic of our framework says we should be looking for ways to do more. It's not completely straightforward because, of course, we're now dealing with a variety of non-standard policy tools. We can't just lower the federal funds rate 25 basis points like in the good old days. But your basic point is right, that you know, we need to adopt policies that will both achieve our inflation objectives and help the economy recover as quickly as is feasible. And I would say that your question actually, and the earlier question, shows a benefit of explaining this framework, because the framework makes very clear that we need to be thinking about ways in which we can provide further stimulus if we don't get some improvement in the pace of recovery and a normalization of inflation.
Thank you, Patrick, and then we'll go to Zach, and then we'll go back over to Steve.
Mr. Chairman, Patrick Welte from the Frankfurter Allgemeine Zeitung. I have two short questions. Your predecessor, Mr. Greenspan, once said about his personal long-term inflation goal that it would be 0% if appropriately measured. And I would like you to compare the inflation goal you told us about today with that statement. And the second question is, comparing what you did today, are you approaching more some kind of inflation targeters like the Central Bank of Sweden or Norway, or are you approaching more the European Central Bank, for example, which has some kind of inflation goal but is not really an inflation targeter?
Excellent questions. So a literal reading of price stability would say inflation should be at 0. Now, there's some technical reasons why that may not be true. There are probably some measurement biases and other issues that mean that a measured value of inflation above 0 is probably consistent with stable prices. But as we've talked about frequently, we set our inflation objective in a way that was consistent with both sides of the mandate. Price stability, and 2% is low enough that we believe that it's not going to extensively interfere with financial planning and economic planning on the part of households and businesses, but also in the interest of employment, a target for inflation that was 0 would have several consequences. First, we would be spending maybe half of our time, or at least a significant amount of our time, in a deflationary zone. And we've seen in many instances that deflation can be bad for economic performance and bad for employment, and therefore setting inflation target at 0 would be not consistent with the other part of our mandate. Incidentally, related to that, a 0 inflation rate would mean that nominal interest rates would be at very low levels, typically 2 to 3% or whatever they might be, and that would increase the risk and probability that we would be in a situation like today where we really can't cut the short-term interest rate any further. So I think there are good reasons from a dual mandate perspective to have inflation greater than 2%. And I would add that, you know, if you look at central banks around the world, whether they're nominal inflation targeters or not, that 2% is basically the number that most central banks use. The ECB, many other central banks either use 2% or a range around 2%. So this is not at all different from what many other central banks do. Now, are we inflation targeters? If by inflation targeter you mean a central bank that puts top priority on inflation and other goals like employment as subsidiary goals, then the answer is no. We are a dual mandate central bank. We put equal weight on price stability and maximum employment. Those are the goals given us by Congress. And so in that respect, as I mentioned earlier, I think to Greg, we're not absolutists if there's a need to let inflation return a little bit more slowly to target in order to get a better result in employment, then that's something that we would be willing to do. Having said all that, I think it's worth noting that even banks that, central banks that call themselves inflation targeters typically pay at least some attention to other parts of the economy, employment, growth, financial stability, and the like. So I don't think there's really any central bank, or very few at least, that focus only on inflation. But again, in terms of terminology, I guess I would reject that term for the Federal Reserve, because we are going to be even-handed and treating the price stability and maximum employment parts of our mandate on a level footing.
Go to Zach, and then we'll go to Steve.
Thank you. Zach Goldfarb from the Washington Post. 2 questions. First, can you clarify whether if actual economic conditions match the projections, that's an acceptable future course, or that would require additional easing? And secondly, in the past, a number of times you said that even when interest rates are at the 0 bound, the Fed can still have a significant impact on influencing economic growth. Do you still believe that the Fed has the capacity to deploy tools that would have a significant impact on bringing down unemployment at a faster pace than we see in these projections if it chose to do so?